Hello and welcome to this special edition of the Lockton Marine Podcast. I'm joined today by my colleague Pippa Atkins and Gary Field, Chief Underwriting Officer at Steamship. Welcome to both of you.
Morning.
Thanks.
Morning, guys.
Pippa, we've recently released our P&I report, and there was a market event 2 weeks ago to celebrate that. Before we go into some of the specifics of the P&I report, maybe not all of our listeners are familiar with what it is. What is the Lockton Marine P&I report, and what can people find within?
So the P&I report is something that we have done, I'm going to say, for the last almost probably 15 years. In essence, it's a comparison document which shows a full summary of all of the club's data, primarily for the last 3 years, and it's rolling, so that each year is an update on those 3 years. And then in the back, there's an appendix that's got all of the back year data. So in theory, you can go back and check how all of the club's financials have changed or developed over the last 15-year period. And then probably 5 or 6 years ago, maybe we started including the fixed premium market data. So that's now included at the back, as well as all of the kind of back year historic data tables. And then every year we have an editorial at the beginning, which is kind of a run through of the current state of affairs in the P&I market, any current affairs, anything like this year it touches on the Dali, the dark fleet, stuff like that, current as we come into the renewal.
So on the subject of this year's report, any new developments? What's new with this edition?
This year we have the look and feel of it have been updated, so it's had a bit of a refresh, so it's hopefully slightly more interesting. The data that we've included is more extensive than it has been in the past. We've simplified aspects. Before, we used to get bogged down in policy year, financial year data, and actually now I think it's just a snapshot of the same position for all of the clubs. We have updated the historic data, so the idea is that it contains as much data as possible rather than dropping off anything that we can't fit. It's been mobile optimized, so you can check it on your phones. And then there is a comparison, like an online comparison tool that we launched a few years ago, but that's also had an update, so it's got increased functionality. That's mobile optimized, and in that comparison tool you can kind of select the bits of financial information for each of the clubs that you want to compare. So it's useful if you're building a comparison between a few specific clubs. It's a quick way of getting a good snapshot.
So at this point, I'm guessing that all of our listeners will be rushing to check out the most recent edition of the Lockton Marine P&I report. Where may they find it?
On our website, or they're just www.pnireview, like pandyreview.com.
Great.
And it can be downloaded there.
Fantastic. So, Gary, you were at the launch 2 weeks ago, and I'm sure you've read the report and the editorial in detail. What are your thoughts on what the main issues are going into this year's renewal, or next year's renewal, rather?
Indeed. Firstly, I think it's a great the gathering that you guys arranged was really well attended, and I understand many offline as well, virtually attending, which was great for you guys to have that and to showcase your report. I want to also congratulate you for having a very helpful glossary at the back of the report to explain some of the long words that only Steve Hawke understands. So that I think has made it much more user friendly. I think the issues that are coming out in this renewal are really sort of crystallized by the obvious thing that drives balance sheets for clubs, and that's claims, it's premium, and it's investments. And there's some rather interesting elements within those three disciplines that drive balance sheets. And on the claim side, the big question is what's happening with the pool. We've seen over recent years how unbudgeted, unexpected pool variations, whether up or down, can really influence the fundamental combined ratio outcome for clubs. So I think back to, I think it was 2022, 23, we had real volatility in the pool. Steamship's financial year combined ratios in those 2 years were 113 and 125% respectively. Our estimates are that had we got our original budget for the pool years correct in those years, our combined ratios actually would have been more like 105 and 110%. So you can see the effect there on the overall position for clubs when it goes one way or the other. And of course, lo and behold, 2 very benign years, and now this year, a lot more volatility. Difficult to go into too much detail for obvious reasons about those estimates, but I think we're going to see that this current pool year returning to around or maybe even above the levels that we experienced 3 or 4 years ago. So the big question is this the new now, or are we returning to 22, 23? What are we expecting going forward from the pool? And it's so hard to assess the volatility that you see with these large claims. So I think that's absolutely one of the core discussions that the boards would have been having about how to get your arms around estimating that exposure. On the premium side, I mean, the world fleet has grown precipitously, of course, in the last 10 or 15 years. It looks as though from the Clarkson's data, that's just beginning to slow down a little bit. We know that excess loss last year was a little bit kinder. I have to see what happens this year with excess loss. But I think that income into clubs is generally moving forward still. The question, of course, is whether or not the premium levels are sufficient to deal with the volatility we're seeing, and what are clubs seeing within their own retained claims. That's very difficult, of course, for us to assess. But it's interesting, I think, that at the half-year point, the half a dozen clubs or so who issued their thoughts on their combined ratios at that position in the year were largely reporting underwriting deficits. And had we been talking about potential general increase ranges maybe 6 months ago, I think a lot of us would have thought 0, 2.5, maybe some at 5, and the pool situation has maybe edged us up a little bit more, as we're now seeing with general increases, with 5 maybe being the median. And just finally, very long-winded answer to your question, but on the investment side, strong returns. So we announced in our circular that at the halfway point in the year we were around $70 million up. We're rather risk averse in how we invest our members' money. The portfolio is designed for capital preservation rather than capital growth. But we're seeing the benefits of the extent to which we're in the bond and cash markets. And I think what's interesting for me, Anders, over the next couple of years is the fact that many clubs have gotten a little bit more risk averse, as we did a number of years ago, actually, in how they're investing their members' money. And with the bond markets being as they are at the moment, and given the clubs, I'm assuming, are buying bonds in a relatively short-term periods, but to mirror their claims tail exposures, that the clubs will see a propping up of their balance sheets through relatively positive investment returns for another year or two. Obviously, interest rates are changing, bond yields may therefore be moving in a more negative direction. But for now, I think it's an interesting phenomena that most of the clubs should be, for a period of time, seeing some support on their technical results from the non-technical account on their investments.
Thank you. I want to ask you a question about the pool claims, because it seems to me, and this might be entirely wrong, that the type of events driving pool claims is slightly different than it was historically, right? And what I mean by that is that seemingly normal navigational technical issues take on a completely different life because of the regulatory climate, because of the political climate, and because of the environmental pressures that we see all over the world, meaning that a cleanup, a wreck removal, disruption, all of these things become magnified many times as compared to what it was. Is this well, first of all, do you agree or disagree with that? And if I am indeed right, is there any sign that this is changing, or is it only going to get worse?
I think broadly speaking, you are right. It's often very difficult, of course, to do a like-for-like comparison on claims from a number of years ago and identify something very specific where you've got such a relatively small number of events in the general scheme of things and so much volatility. But I do think you're generally right. There's, as you mentioned the regulatory framework that ship owners are having to abide by. That's driving damages. Commodity prices have gone up. That's going to drive loss, replacing steel in the event of FFO claims and collision, more expensive than hitherto. And we've seen a lot of convention creep over the last 5 or 10 years, which has driven the extent of damages that members are exposed to. I think the other angle to this, maybe, Anders, is the technical advancements that we've seen generally. You can now remove a wreck that maybe hitherto wouldn't have been quite so possible without that technological advance, and that's driving loss. And I think also the reaction of juries to events, the perception from the public on the value of money. I mean, this might be a relatively US centric comment, and of course we have a lot of US business, but we've seen some quite startling US jury awards over the last 3 or 4 years. That's something that the international group are actually working on in a collaborative way to understand what's happening there more. So if you think about all of those individual items, there does appear to be sort of a perfect storm within there that's potentially making exposure greater. And we haven't even mentioned the effect of inflation, of course, which is very much with us.
So convention creep, is that a Gary Fieldism, or could I steal that? Because that's a great term.
If you like it, then it's most definitely from me.
Thank you. Addressing the steamship in particular, you've had some very impressive results. So congratulations to you as the Chief Underwriting Officer. Could you give us some insight as to what lies behind those results?
Well, I appreciate that, and I'm quite certain it's nothing to do with me, but rather the fantastic underwriting and claims teams and everybody else that we have here. But I think what we're seeing, there's always an element of luck in this, Anders. Your comments are very kind, but there has to be an element of luck. But at the same time, one would hope that if we are appearing in the top quartile over longer periods of time and individual years, that there's something about our risk appetite, our risk tolerance, and how we generally approach selection of business. We've seen a lot of growth at Steamship over the last 6 to 8 years. I think that even I'm surprised to hear that Steamship has in fact grown by more than any other club in the international group over the last 8-year period. We've gone from 83 million tons to over 130 million tons at the start of this year. And equally by premium, we've outgrown the average in the IG. So the question is, has something happened there to change our philosophy? Because we've generally been, I think, a conservative club, a risk-averse club wherever we can. And the interesting point for me is that of that growth, 2/3 of it has come from organic growth. It's been members adding to their entries. It's been a consolidation of split entries in our favour, which I personally see as more of a sign that we're doing something right than brand new business joining us, because the consolidator is voting on the basis of experience, and that's been a pleasing situation for us. So we've tried to remain sensible and prudent with our underwriting in spite of that growth. And what I'm happy about is that in the main, our underwriting performance has stayed in the top quartile. Because I think there's a natural belief that if you grow precipitously, that's probably going to come at the cost of performance. And I'm not sure that's always the case. I think another thing that we try to work on is really appreciating that from a member standpoint, their costs is not just the premium angle, it's the retained risk angle. There's a lot of analysis on total cost of risk to our owners, and the need to consider the effect of reinsurance when a member is buying $1 of actual cover from a club. It's not going to cost him $1. And I think to some degree we've been working harder and harder to try and protect our combined ratio by thinking more about how entries are structured with the club, how members retain risk, how you're not dollar swapping at the lower end. And I think that has perhaps been a feature as to why we've managed to see the results that we have. And we have a fantastic membership who do the right things. They're invested in loss prevention and risk management. They run their companies extremely well and prudently, and that's testament to them.
And obviously all of this is to set you up for the inevitable question, So why do you still need a general increase for this renewal?
Yes, well, it's a completely obvious question, but I'm glad you've asked it. It's a question we get asked and have been asked over the last 6 or 8 years. And as you guys know, we have returned capital to our members on a regular basis. I think this latest round of distribution means that we've returned over $150 million to our mutual members in the last 8 years. And therefore we are asked the question, well, you're returning money on a fairly regular basis, but asking for increases. I always look at this situation as being two sides of the same coin. I think on one side of the coin, you've got crystallized capital, if you like, in your back years, where you can take an assessment of that money that has solidified, if you like, after a large proportion of your back year claims have come through to fruition. And you can balance that against the extent to which you want to see surplus capital against regulatory ratios. S&P capital ratios is the one that we especially look at there with our board. And if there is surplus over certain parameters against S&P A-rated margins, our board feel that our ship owners would rather have that cash in their own pockets rather than in their clubs. And we're trying to have a balance between how much is returned and how much we should keep for the rainy day. That's all in the past. That's sort of retrospective. The side of the coin that deals with the increase, the general increase, is looking forward. It's looking prospectively to what we expect might come down the pipe next year and looking further forward. And in fact, Anders, and I'm sure you'll be bored hearing this from many of the clubs, in many ways, a 5% general increase doesn't necessarily take you forward dramatically on your underlying rate for the following year. When you take into account what you might actually achieve, and of course we hope we achieve as close to 5 as possible, when you take that into account along with inflation and the effect of the dreaded churn word, it may well be that many of the clubs who have general increases around that range will think that year on year there's only a relatively small increase on the underlying rate per tonne.
Pippa, your client's going to be happy with that answer?
I think it depends where you fall. I think there will be some potentially who would ask the question whether, and I don't know necessarily if it's a fair question, but would that mean, so say that Steamship are routinely giving 10%-ish back in capital returns, should that then be interpreted as Steamship's premiums? Are they inflated by about 10%, would you say, compared to maybe some of your peers? Or would you say that you're kind of conservatively budgeting for whatever your combined ratio will be, 100%, and then anything that you give back on that is a nice to have?
I think what's interesting there, Pippa, with what you mentioned is you talked a lot about the premium side of the club's balance sheet, and you mentioned our premiums inflated. I talked a bit about the bond returns, the investment returns we've seen recently. And you know, our combined ratio is there or thereabouts. We're probably going to be a little bit above break even this year, but not too much. Similarly, last year we were slightly below the 100% combined ratio. It's really been that non-technical account, the financial side of things, that in many ways is bringing this discussion about capital return under the center of the spotlight, rather than the pure underwriting side. Obviously, if you've got large deficits or large surpluses on your underwriting, that equally will dictate the extent to which you have a surplus that you can consider for return. But from our standpoint, given our underwriting position is broadly break even over a relatively long period of analysis, it's really that non-technical investment account that's driving the extent to which we can think about returns, or our board can think about returns.
I think from our perspective, no increase is obviously ever welcome for our clients, but when it's paired with the capital distribution, and also I think the model and the history of your capital distributions, I think that makes it slightly easier for people to absorb.
Yeah, yes. Well, thank you. What's I think interesting also is that we're talking a lot, and all the clubs do understandably talk at this time of the year about their general increase, and some clubs actually seem to be not calling that whatever they're looking for a general increase these days. But it's not applied by tariff. You know, we're a great believer here that good records should be rewarded, and owners that are showing consistent deficits shouldn't necessarily expect that other owners should pay for their losses. So, that general increase for us is very much a guide as to where we want to try and end up at the end of the renewal season. But we will take all individual records into account, keeping in mind there's always a balance between responsibility for your own record and exposure and your mutual obligation to the club. And that's the fascinating dynamic, I think, that the clubs have to try and contend with as they're going through these negotiations.
I want to move on to a slightly different subject. There has been change in the mutual market over the past years. The most prominent change is obviously the North Standard merger, but also the drive towards product diversification. Where do you at Steamship stand on this?
Well, as you know, Anders, we're a monoline P&I club. We have a management team dedicated to just dealing with P&I. That doesn't mean to say that we don't have diversification. We have an enormous charterers book, over 120 million tons of chartered business. We have a yacht facility. We can provide cover for hull war P&I, kidnap and ransom. We've got lots of loss prevention initiatives. We've got a mental health service that has been very, very popular with our owners. So there's a lot of diversification around the core proposition of P&I that I think we do have and enjoy. I think by diversification, you're probably talking more about investing in Lloyd's syndicates and external hull and so on. And I think from our standpoint, our board standpoint, we're certainly not so arrogant as to suggest the way that we look at things is correct and the way some other clubs look at things are wrong. Our philosophy is that we stick with what we know. We feel that we understand our world, our market. It's extremely mutual. And what I mean by that is that we're not necessarily exposing the mutual funds to the ebb and wane of commercial markets, as I think is probably more the case with the hull arena. And as things stand, I mean, never say never, of course, but as things stand, I think our board are happy that we stay true to mutual principles and solely focus on the P&I world.
I want to pick up on one point you mentioned there, your mental health service. So we talk about, money and premiums and these fantastic floating assets that our clients have and the businesses they've built around it. But sometimes we don't talk enough about the people at the center of it. So the seafarers and the crew and knowing that there are significant crew welfare and mental health concerns. Could you please elaborate on your services in that space?
Yes, well, our service is free for our members. It's a 24/7 helpline, and we've seen, as I say, the take up is most definitely there and increasing, and the level of interest. And in some ways, of course, that level of interest that increases suggests a degree of concern. But I think it's fantastic that there is this opportunity for our crew, our members' crew, to be able to speak freely and to be able to deal with these mental health pressures that I think in the confused world that we live in, and you think about the geopolitical situations and the large swathes of our crew that are at sea that will in some way be affected by some of these geopolitical issues, not just indirectly, but directly, and their families as well. It's ever more important that this service is available. And it's an interesting point you make, Anders. Of course, we can get too caught up talking about premium and investments and so on, but ultimately it's all about the people, and it's about the quality of the crew that are being attracted. As I said earlier, in a growing world fleet, and there's always pressure on crewing. So I think that all of this work that's being done and all of the loss prevention that's being done behind the scenes by all of the clubs who provide excellent loss prevention support, ultimately it's all about providing a better environment for the crew to work on, whether that's dealing with safe lifting and handling, or it's dealing with the mental health side of things, or the environment in which they're working and how safe it is. All of these issues actually come together within the jigsaw to try and protect members and to mitigate exposure. But at the kernel of all that is a very important feature, which is safeguarding crew, both physically and mentally.
In summary here, what I'm hearing is that through all of this volatility, Steamship are doing very well, and that there is a focus on the core business as usual, and making the best possible offering to your membership. Yet we have heard rumors of one major change, and that is you yourself stepping down from your role. What does future hold for Gary Field?
Well, there's a question to ensure all the listeners, or both of the listeners, turn off. Before I mention anything about me, just your point about the club's doing very well. It's very nice of you, Anders, to use the word very. I think that we would say that we are doing fine. We're doing quite well. I mentioned earlier about luck. I mentioned earlier about how you have to keep focused on that underwriting position, not rely upon the investment returns. We've got to stick to our principles, our conservative principles, and how we grow the club to continue doing as we are. I don't think that anyone here would get carried away with recent results or the ability to return money. We're going to stay prudent. In terms of me, I think it's part of a larger succession change that we've been going through. Of course, succession is a great battle for everybody. I'm sure it is for PL Ferrari now. I think that Steve Hawke is close to his 85th birthday. But from our standpoint, Stephen Martin, of course, stepped down from the senior position a couple of years ago. Jonathan has come in and done a fantastic job. I think we've had change, but we've had continuity, and that's testament to the work that Jonathan's done with a strong management team around him. And we're continually looking at our younger people who we're very keen to invest in. I think we've got a great group of people coming through the ranks. So far as I'm concerned, I will step down after 7 or 8 years, I think, as head of underwriting in the spring next year after our London board meeting. And I will continue with the club and carry on working with a keen eye on member relationships, business development, working with our London market, working on opportunities around the world. And I'm really looking forward to that challenge.
Sounds good. I like how you qualify. So I say very well. It's like asking, or you say to any old person, "You look great." They will always respond, "Yes, but I feel terrible."
Are you back to Steve Hawke again?
Well, he should have been here to defend himself.
Well,
maybe
true.
we'll have a
I'm not going to defend him.
No, I'm certainly not.
An episode in which he gets to respond. Any parting thoughts from either of you?
Pippa?
No, I think I'm good, thanks.
Yeah, I think I'm happy.
So to everyone, go read the P&I report. Any questions you may have, direct them to either Pippa Atkins at LocktonPLFerrari.com or to Gary Field, and I'm sure any question can and will be answered. Thank you so much for listening, and the Lockton Marine Podcast will return soon. Goodbye.